has a limited value in cash planning. There is no adequate substitute for detailed cash forecast, possibly linked with a financial model of the business as a whole. For an outside observer, and to some extent for the board of a company, useful information can be derived from a trend of liquidity ratio, incorporating not merely cash but also those elements of working capital which are rapidly convertible into cash. This concept of liquidity was built into the source of application of fund statement described above. Investing surplus funds. If the cash forecast for a business shows surplus funds becoming available, now we'll talk about investing surplus funds. If the cash forecast for a business shows surplus funds becoming available, then plans should be made for putting them to use. However, the surpluses may be transitory, either because they are being accumulated deliberately for some purpose, as the purchase of plant or the payment of taxes, or because the business is seasonal and the funds will eventually be required to finance off-peak activities. It's important to schedule in detail with frequent reviews how much money will be available for various period of times so that it can be put to the best possible use. Small amounts which are required to be kept liquid are probably best placed on deposit with a clearing bank or other finance house. The rate of interest will be low, but only short notice is required for withdrawal. When large sums are available, there is a greater range of investment alternatives. Loans to local authorities or merchant banks or local authority bonds have various terms from days upon up to 5 years, so they can match the availability of funds. However, they are not readily negotiate. Negotiable certificates of, of deposit issued by the commercial banks overcome this disadvantage, offer a higher rate of interest, and can cover a wide range of maturity from 3 months upwards. holding under stable conditions. If the stock holding exceeds the peak level, this provides a warning that demand has been running below the rate expected when the EOQ was fixed. The stock controller should then review the correctness of his standard purchase order quantity. A minimum stock level, which as suggested above, is probably the amount of the safety margin. The minimum stock level provides a warning of potential out of stock position. When a stock holding falls to that level, the stock controller will review his outstanding purchase orders and their due dates, and also the current trend of demand, and can then decide whether additional emergency procurement is necessary. Under the periodic review system, purchase orders are placed at fixed intervals of time, but the quantity order can be modified to meet the rate of demand indicated by current experience. This gives an opportunity for analyzing the trend of demand and various technologies such as exponential smoothing can be used in forecasting this trend. The system does not respond with minimizing the firm's risk of insolvency. In the context of tax management, the term insolvency is used to describe the situation where the firm is unable with maturing liabilities on time in case the company is technically insolvent, in that it lacks the necessary liquidity to make prompt payment on its current debt obligations. This could be met quite easily by carrying large cash balances to pay the bills that come due. production. After all, would soon come to halt should payment for raw materials purchases be continually late or omitted entirely. The farm good times. This presents a classic problem of making a decision where there is a trade off between risk and return. There are two major types of leverage: financial and operating. Financial leverage is specifically the extent to from which a firm gets its resources from borrowing as opposed to issuance of additional shares of equity. The greater the debt compared to equity, the more highly leveraged the firm because debt legally obligates the firm to interest payment. These interest payments represent a fixed cost. It is estimated by doubling the stock available in an increase of 25% sales value could be achieved. Alternatively, if 3 months stock were held, then sales could be increased by 35% from the present level. The effect on profits of these two alternatives, including any relevant changes in costs, is illustrated on the following page. This somewhat exaggerate example draws attention to 3 points which are relevant to any further discussion of the financial implication of stockholding policy. We can see the table here. Rupees no credit, 1 month's credit, 2 months credit. Sales debtors stocks less creditors, say 1.12 of sales value. Total increase in working capital through granting credit. marginal contribution, less cost of credit control, bad debts, relevant comparable profits, increase in profits, but the company requires a return of to 50% on the increase in capital employed. The net the net advantage or disadvantage of the proposed changes in credit policy is therefore there are some points that you need to note here. There may be a point beyond which further increase into stock will not give rise to sufficient additional sales and gross profit to justify the additional cost involved. Credit terms affect Kalpana's after tax income. Here the solution is that to answer first, first calculate the new and old investment in AR. Old investment in A by A upon R is equal to 75 days multiplied by rupees 50,000 per by day multiple multiply by 0.85. Is equal to rupees 31 lakhs 87,500. New investment in A upon R 40 days multiplied by rupees 48,000 multiply by 0.85. 1 lakh 16 lakhs 32,000. Investment in A upon R is equal to 15 lakhs. Investment in A upon R is equal to 50 lakhs 50,500. There are three expected changes in after-tax net income. Financing cost of AYR investment rupees 15 lakhs 50,500 multiplied by 0.20 rupees 1,866,000. Bad debt expense is equal to 0.05 multiplied by rupees 50,000 multiplied by 365 minus 0.03 multiplied by rupees 48,000 multiplied by 365 all multiplied by 0.60. So it will be it's equal to 232140. Profit on sales is equal to rupees 2,365, 150 and 60, 0.60. 65,700. Net profit is equal to rupees 3,53,100. The third example is that the Dry Den company currently offers trade credit to its customer on terms of net 30. Daily credit sales average rupees 2 lakhs 50,000, on which the company earns a contribution margin of 25%. The average collection period is of 45 days. The company's marginal tax is 30% and its after-tax discount rate for analyzing credit policy changes is 8%. A. There are some point A, point B, and point C. Point A represents that under the current policies, what is the company's investment in current accounts receivable? What is the annual after-tax financing cost associated with that investment in account receivables? Point B. The company is considering offering credit terms of 2 by 10 net 30. If the discount is offered, an estimated 85% of the company's customers will choose to take the discount and the average collection of period will fall to 80 days. Assuming the change in credit policy has no effect on daily sales, what will be effect on the company's after tax net income? Point C. Suppose the change in credit terms also reduces daily sales by rupees 4,000, lower bad debt expenses from 5% to 2% of sales, and saves rupees 60,000 per year in credit department expenses. Will it be profitable to change the credit terms? What is the solution of this example is that for point A, under current policies, investment in A upon R is equal to rupees 250000 multiplied by 0.75 multiplied by 45 days is equal to rupees 8 437,500. Cost of financing A upon R is equal to rupees 8437500 multiplied by 0.08 is equal to rupees 6,75,000 triple zero. 6,75,000. Now we will talk about point B solution. The new investment in accounts receivable will be investment in A by A upon R is equal to rupees 250000 multiplied by 0.75 multiplied by 45 minus 18 is equal to rupees 500 5062 500. The changes in after tax income are cost of financing A upon R is equal to rupees 5062 500 multiplied by 0.08 is equal to a firm. The riskier it's it 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 is because of the obligations related to fixed costs that must be met whether the firm is having a good year or not. At the same time, the more highly leveraged, the greater the profit during good times. This presents a classic problem of making a decision where there is a trade off between risk and return. There are two major types of leverage: financial and operating. Financial leverage is specifically the extent to from which a firm gets its resources from borrowing as opposed to issuance of additional shares of equity. The greater the debt, Compared to equity, the more highly leveraged the firm because debt legally obligates the firm to interest payment. These interest payments represent a fixed cost. The upshot of this problem is that because of the all things that might happen,
Yeah, I saw that. કેટલોક વાંચવા દોસ જોવા દે
the minimum cash balances desired by the management of the air carriers tends to be large. In addition to cash flow predictability, the precautionary motive for holding cash is affected by the firm's access to external funds. Especially important are those cash sources that can be tapped on short notice. Book building relationships and establish the lines of the credit can reduce the firm's need to keep cash on hand. Hence, this unused borrowing power will obviate somewhat the need to invest in precautionary to invest in the precautionary balances. In actual business practice, the precautionary motive to a large extent by the holding of a portfolio of liquid assets, not just a cash. In large corporate organizations, funds may flow either into or out of the marketable securities portfolio on a daily basis because accurate rate of return can be earned on a net near cash assets compared with a zero rate of return available on cash holding. It's logical that the precautionary motive will be met in part by investment in marketable securities. Now we will talk about the another motive sector. Another motive point, key point is that speculative motive. Cash is held for speculative purposes in order to take advantage of the for profit making situations. Construction firms that erect private dwelling will at times accumulate cash in anticipation of a significant drop in lumber costs. If the price of buildings supplies does drop, the company that build up their cash balances tend to profit by purchasing material in large quantity. This will reduce their cost of goods sold and increase their net profit margin. Generally, the speculative motive is the least important component of firms' preference for liquidity. Major problems areas where you are criticized if you don't and criticized if you do. Through the production process will eventually be halted should too little cash be available to pay bills. Interest rates falls substantially below the coupon rates offered on the security, and the investor will use the put option if he can go get better returns elsewhere. For bonds with call or put option, the yields are calculated to the nearest year at which the call put option is exercisable. This yield is known as yield to call, which is different from the yield to maturity. So now we will talk about the sinking fund, a provision that requires the corporation to set aside a fixed amount each year to help provide for the orderly repayment of the debt issue. It's mandatory for the issuing company to get the credit rating done on debt security issue. Credit rating are also mandatory for commercial paper and fixed reporting issue of the company. A rating reflects the probability of the companies going into default. The higher the rating, the lower the risk of default that is associated with the issue. This is also has an effect on the rate of interest offered on the issue. The methodology and the rating symbol remain the same as as in money market security. Types of debt securities. There are several types of debt securities available in the market. The range includes government securities, debentures, deep discount bonds, zero coupon bonds, etc. So, what's government security? We will talk about the government securities right now. Government is the one of the biggest borrower from the capital and the money market. We have already taken a look at the money market securities offered by the government as also the schemes run by it through the post office. Government securities is the generic term applied to various kind of debentures and bonds offered by the government and quasi-government agency. The maturities of government. There are two types of government securities that are offered. Government of USA floating rate bonds which pay a floating rate depending upon the base rate of announced by RBA, RBUS. Government securities, regular debentures with which pay a fixed rate of return and the principal amount of is returned on maturity. The last issue The last issue of government stock paid a coupon rate of 6.50%. The percent yield on government securities is in the range of 5.50 to 7% depending on the maturity. Non-convertible debentures. NCDs. NCDs are planned debentures securities issued by corporations. They are normally medium term in nature, maturing between 1 to 8 years and generally have a repayment schedule staged, staged, staggered by or 2 or 3 years. They are secured by a collateral backing and credit rates. Interest rate of- offered on medium term NCDs is usually lower than the market rate. So many times the companies offer a swap of equity warrants along with NCDs to sweeten the issue. Interest rate on the short term NCDs is in line with market rate and depends upon the quality of the issuer. Deep discount bond DDB usually long term with maturities exceeding 10 years. Deep discount bonds are normally issued by blue chip corporation or financial institution like money market securities. These bonds are issued at a discount to their face value because of long maturity. Period period the discount is also higher. Hence the term deep discount. Although long term maturity is the norm, short maturities are not uncommon. For example, GE Capital had an issue of DDBs with a maturity period of 17 months and 29 days. The first issue of DDBs was made by Small Industry Development Bank of India, Bank of US, alright, SIDBI. Each DDB with a face value of rupees 1 lakh was issued at the discounted price of rupees 200 2015 500 with a maturity period of 25 years from the date of allotment. Both the investor and SIDBI have an option of withdrawing or redeeming the bond, call and put auction, respectively, at the end of 5th, 9th, 12th, and 15th and 20 years from the date of allotment at the deemed value of rupees 5300, rupees 9600, or rupees 15300, or rupees 25300, and rupees 50000 respectively. After the success of SIDBI issue, all the prominent financial institutions like IDBI, ICCI, etc. etc. came out with the issue of DDBs. All these issues, however, were called by the institution as the interest rate fell. Zero interest bonds, ZIBs, very much like DDBs. The only crucial difference is that these are issues at face value. Are issued at face value. DDBs are issued at a discount of face value, and the redemption is at a premium. Tax treatment of both is the same. Secured premium notes. Zero interest bonds. DDBs. Yes. Very much like DDBs, the only crucial difference is that these are issued at the face value of DDBs are issued at a discount rate of face value. And the redemption is at a premium. Tax treatment both is the same. Secured Premium Notes SPNs. SPNs are bonds issued by corporations which are medium term in nature, uh, maturing between 3 to 8 years. The advantage is the flexibility it offers in giving the return as premium or interest payments depends upon the preference of the holders. The only issuer of SPNs in the US market till now is Tisco Limited. The it issued SPN. It issued SPNs rupees of rupees 300 each. The repayment started after 3 years, and there was no payment of interest in between. The repayment went the repayment went on for 4 years, starting from the fourth year to seventh year. Every year there will be a payment of rupees 150 rupee, totaling rupees 100, total 6,600 in 4 years. Rupee Pinchotter in this eh, would be accounted for as principal repayment, and the rest rupees 75 could be taken a mixture of interest and premium at the option of the investor. The advantage of this was easier tax planning for the investor, but the tax authorities were not happy with this kind of an arrangement. Tisco also attached an equity warrant which was convertible into equity at a price which was a considerable discount to the market price prevailing at that time. Floating rate bonds FRBS. Bonds whose interest payments fluctuate with changes in the general level of interest rates and are tied to a basic rate known as a reference rate. The first issue in India was from State Bank of India (SBI). It issued um, unsecured re- redeemable subordinated floating interest rate bonding in the nature of promissory note carrying a coupon rate of 3% per annual above the bank's maximum term deposit rate. Pass-through certificate PTCS. Pass-through certificate PTCS are debt security that pass through income from the debtors through intermediaries to investors. Primarily banks who have a strong retail loan portfolio are the intermediaries who issue these certificates. The most common form if pass-through is mortgage-backed security. In which the principal and the interest payment from the home loan takers are passed from the banks and savings agencies that pool and repackage them in the form of security. To investor, the bank collects the payments from debtors, charges a fee for its services. Which is dedicated from the income passed on to investors. These securities are credit rates and the interest payment is according to the rating. The rating is followed by to denote the transaction is that of securitization. Rate of return of a bond. In case of bonds, in case of bonds, instead of the dividends, the investor is entitled to payment of interest annually or semi-annually. The investor also benefit if there is a appropriation in the value of bond. Otherwise, there is a redemption of the bond at par value or at premium. Using the present value formula developed above, we can say that present value of bond is equal to interest rate sigma n raised to n to t is equal to 1. Interest rate upon 1 plus I raised to t plus principal amount upon 1 plus I raised to n. Here, interest amount is individually brought to its present value, or we can apply the annuity factor table to get its present value. The principal amount is brought to its present value when it's due. Or to use the table change would be present value is equal to in- interest amount multiplied by present value or annuity factor ni plus principal amount multiplied by present value interest factor ni. Example: a boy is a bond is paying 10% of interest per annual and is going to mature in the next 2 years. At maturity, it will pay its principal amount of rupees. So, If the expected return on bonds today's are 7%, 10% for 350%. What are the value would you pay for the bond today? Solution is that we have to we can say that we have to use this above formula. Present value of a bond is equal to 10 upon 1.1 raised to 1 plus 10 is equal to 10 plus 1.1 raised to 2. 100 upon 1 plus 1.1 raised to 2. For to use the tables, the change would be present value is equal to 10 is equal to PVF2 the point 0.1 or is equal 400 dot PVIVF2 0.1. Substituting the values, we find that present value is equal to 100. This is no magic. When you are getting 10% return and also expect a 10% return, the price you would have to pay would equal to the par value of the bond. This means that if we expect a higher return, 15% in situation, third one is price above the price that we would be willing to pay for a bond returning only 10% would be less than the par value. Similarly, if we expect lower return, there are five variables in this case: present value, future value, interest amount paid, return expected, and time period. Properties of mathematics say that if any four of these five variables are given, you can always find the value of fifth variable. You can attempt that yourself to turn over or solve example to look at a similar case. Mm, Now we will talk about the valuing equity securities. Unlike debt and money market instruments, equity instruments represent the ownership interest in the company. As, as owners must put in their money in the venture before anybody would lend to them. Equity is always issued before debt is released by the institutions. In fact, the incorporation of the company requires that the promoter must pick up some shares in the company. Only then the company can be incorporated. As equity represents the owners, but it's logical that all the debt holder must be paid off before owners can claim any return from the company. So the equity has the lowest priority claim on earning. Equity also has the last claim on the assets in case the company is liquidated, closed down. This means that the equity carries the highest risk. No, without reason. The flip the flip side of the coin is that the equity owner are also the owner of the profits that remains after all the debt holders are paid their interest. The interest payment is fixed while there is no limit on the level of profits can put. The interest payment is fixed while there is no limit on the levels of profits that can accrue to the equity holder. Vice versa does not apply here. The liability of the equity holders is limited to the level of investment that they have to put into the company and not unlimited. Now we will talk about the valuing equity securities, right? Unlike debt and money market instruments, equity instruments represent the ownership interest in the company. As owners must put it in their money in the venture before anybody would lend to them.